So welcome. This is the Investing During Inflation webinar. My name is Marshall Beyer, and I'm the Senior Director at the Canadian Securities Institute. And I will just take a brief moment to introduce this webinar and the star of the show, our presenter, Bruce Monis. First, I just want to say that information contained in this webinar are statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We also ask that no one record this webinar without Moody's explicit written permission. And lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. Today's webinar is being recorded, and the recording will be made available in the coming days. All members of the audience are currently on mute. If you have a question, and we encourage you to ask questions, please type it in the Q&A box at the bottom of the screen. Bruce will answer the questions at the end of his presentation. The presentation will last around 30 to 40 minutes or so. And we ask that you keep your questions as generic as possible and avoid personal or client-specific information. When I look at what's happening in the markets and the economy, I feel to some extent like my career in financial services has come full circle. Dating myself here, but I started in August 1982 with an investment dealer, and it was during that month that the Dow Jones Industrial Average finally broke through the 1,000 level mark after spending literally over a decade in a trading range between 600 and 1,000. It took 3 mighty attempts to break through 1,000, but it finally did it in an explosive way and never looked back. That was the start of the secular bull market in equities that arguably has lasted 40 years or so. It also marked the beginning of the bull market in bonds. The sideways range in equities in the 1970s came during a period of very high inflation and even stagflation. So real rates of equity returns were quite often negative. PE multiples were very low, and all in all, it was not a great period of time to be in the market, with the exception, of course, of certain inflation-sensitive sectors. We obviously don't know what the future holds from here. Will the current inflation be just a temporary spike, or will inflationary expectations and psychology take hold as they did in the 1970s and result in a longer-term inflationary trend? This inflation investing webinar provides insights as to how to manage your client portfolios during periods of increasing inflation. I should mention that in addition to this webinar, CSI has just released a new CE e-learning course entitled Investing in Inflationary Times, which is largely what this webinar is based on. The e-learning course satisfies 3 continuing education professional development credits, and you can find it on the CSI website. This webinar is being presented by Bruce Monis, who has over 25 years of institutional portfolio management experience in senior roles with Imperial Oil, Manulife Financial, and ING Investment Management. His responsibilities have included equity, fixed income, and alternative investment mandates, where he led in the creation, approval, and management of the first hedge fund in Canada for an insurance company. Bruce has served as a consultant and lecturer to the financial services industry for the last 15 years or so, with a focus on portfolio management, advanced derivatives, ETFs, and hedge funds. He is registered as an ICPM and a commodity trading manager. Bruce has a CFA and is a member of the Toronto Society of Financial Analysts. So we're very happy to have Bruce here. And Bruce, I'm going to turn it over to you. Thank you.
Thank you very much, Marshall, and good day to everyone. I want to start slide number 2 and give you a high-level introduction as to what we'll be going through in the next 45 minutes or so. We're covering about 40 slides. I like to think all slides are important, but there's 4 or 5 that are going to be very critical, in my opinion. And I will be sure to point out which slides or what information on those slides is to me, very important and critical takeaways from the next hour or so together. We'll first have a peek at asset classes and how they've actually returned in inflationary time periods. We'll then spend the bulk of our time in fixed income. We'll spend some time in commodities. We'll then spend a good piece of our time in equities, and then we'll finish up all the alternative investment products. Now, one thing I'd like to say is, first of all, as a very brief coverage, I wanted to have a snapshot of how the various sectors and asset classes have performed in the past year. This is up to April 20th of this year. No particular rhyme or reason to this list other than to provide a representative smattering, I might say, of different types of investments that you and your clients are invested in, and put them on one piece of paper or one screen so you could see how the spread in performance has been, especially relative to, in this case, US inflation. By the way, nothing against Cathie Wood or for Cathie Wood. I've never held ARC. I don't hold the inverse of ARC. I probably never will, but I wanted to include it on the list, being as it does give it, it's topical, and it actually is a pretty good handle on extreme growth stocks. But we can see that definitely we're in an environment where the market overall, the capital markets, are particularly interested in resources, and that's very, very clear. On the flip side, we can see where the market definitely is not that interested. On the other hand, I do qualify that this is only for a 1 year period of time. Now, looking at more important portrayal, this is the first slide, I think, which in my mind is very important. In most of your studies and most of your work activities and most of your research, you would find that asset class selection and asset class analysis tends to be driven by economic cycles, i.e., are we in inflationary, are we in a growth environment, are we in recession, or what type of growth, what type of fundamental economic growth are we dealing with? And from there, the literature then drifts into and analyzes how do the various asset classes perform in those economic environments. When I prepared the underlying course and this seminar, my approach was quite different. The approach in the seminar and in the course is to look at investing only through the lens of inflation. And the reason is, if you believe that we are coming into an inflationary time period, then what we'll find the market will be focusing on, undoubtedly, is the CPI, the PPI, the price of gold, the price of commodities. It won't be so concerned whether the US GDP is growing at 1% or 2% or 3%. Not saying it's not important, but this particular course looks at markets through the lens of inflation. And the first thing I want to point out on this slide is if you look at the group of data on the right-hand side of your screen, you're looking at, in all cases, you're looking at the performance on an index level of 8 different types of investments or asset classes in different environments: falling inflation, stable inflation, and rising inflation. Of course, the purpose of this course is to look at how that varies. And if we believe we are going to an inflationary environment, then the data on the right-hand side, extreme right-hand side, is what's critical. I did put an asterisk on the bar representing equities, which in this case is the S&P 500, to make one very, very important observation. And that is, the literature generally suggests that inflation is good for equities. And I think that has to be qualified. If you look at falling inflation and stable inflation data sets, what you'll see is those blue bars are definitely superior or have had quite good returns in falling inflation and stable inflation. And that's shown by the 2 panels on the left of the screen. On the right of the screen, you'll see at the index level that equities not only underperform inflation, they actually underperform almost or virtually all other asset classes. And not surprisingly, at the same time, REITs and fixed income are poor performers. But interesting enough, at the index level, equities perform as poor as bonds do. One thing I'd like to say is creating the seminar and creating the course, I took 100 years worth of data. There is 1 or 2 slides I'll show you today that are qualified. They're shorter periods of time, only 30 years and 40 years. But this data you're looking at here, this analysis you're looking at here, goes back to 1920. So fixed income, of course, the mechanism is quite straightforward, and I trust most of you are quite familiar with it, and that is fixed income securities do not behave well in rising inflation environments, or more specifically, rising interest rate environments. The connection is quite straightforward in that if we have increasing inflationary expectations, generally that would lead to a tighter monetary policy, which generally would lead to a tighter credit market conditions. Concomitant with that, you're going to have higher interest rates. From there, we're going to get higher discount rates for fixed income. And actually, I could add, and for equities, and we'll talk about that in the equity section. And last but not least, of course, we're going to have lower fixed income or bond prices because the discount rate is increasing. And of course, bond prices respond inversely to the discount rate. This particular slide, and I apologize, it's a very busy slide. What it is the represents the Bloomberg Global Aggregate Total Return Bond Index. This index was created in 1990. And what you're looking at is, it's a very large index. It's got 62 trillion US dollar equivalent in it, and it represents 28,000 different bonds. On the right-hand side, what you're seeing is the rate of return of that index for each year from 1990 for the 12-month period from January 1st of the year. So what you're looking at in the grayed out areas is the path of the market value of the Bloomberg Global Aggregate Bond Index over each of those years from 1990. And of course, as Marshall mentioned, generically, we've been in a bull market in fixed income, and that's why you see the larger set of curves going above zero, because of course that was leading to positive market value returns in the fund. Now, what I did put on here is the path of that index since January 1st this year. And the index is down, actually that's as of about 8 days ago. It's actually down a bit more now. It's down over 11%. So you can see that at a starting point of January 1st, and we could have picked other dates, but in this case, we decided just to start with Jan 1st of every year since 1990. You can see the bond market performance has been abysmal. I then decided to present this a little different way. I went back to the end of 2016. This is the same index. This is the market value of the index. You'll see it peaking out mid last year, and then of course falling to the 62 trillion dollar value now. So the bond market really is, on a mark-to-market basis, it's really back to what would be May of 2020. So the bond market has been adjusting for various reasons, and one of them I suspect is inflationary, since basically since last summer, although it's become more profound now. In the course, we do discuss monetary policy. We'll keep that brief in this presentation, but of course, one thing you will want to keep your eyes on, or should be looking at in terms of structuring your client's portfolio, especially on an asset mix basis, is that what are measures of Fed tightening? And there are many measures of Fed tightening and many definitions of Fed tightening. I present here one that I use. I'm looking basically here at the 10-year US Treasury yield minus the 2-year US Treasury yield. Of course, when the Fed is trying to tighten the system, trying to squeeze monetary policy, and hopefully squeeze inflation out of the system and or demand in the real economy, what you're going to find, of course, is that short rates will be rising faster than longer term rates. And there's a couple of reasons for that, but the primary reason is that the Fed's firepower, which is infinite, some analysts would suggest, is most expressed in the short end of the yield curve. So understandably, if the Fed wants to slow down the economy, wants to reduce inflation expectations, it will typically do that by squeezing the short end, raising short-term interest rates. In the US case, it'll be the Fed funds rate is where that will start. And then the Treasury rates will follow with that. And then finally, the bank rates will then follow deposit rates, and borrowing rates from bond market will follow after that. So I just want to provide a snapshot here, going back about 4 decades, as to what the slope of the curve, what range it has been in. And of course, when this curve is on the lower part, below zero, we do have a yield curve inversion, at least defined by 2-year versus 10-year versus 2-year US Treasury rates. And we actually this year inversions started. In the last couple of weeks, we've had a bit of a flip on that, a very small flip. But if you do believe that the Fed is going to try to get in front of inflation, or maybe even catch up with inflation, we're going to have to see more yield curve steepening. And it could still go more. You'll notice in the 1980s, we were looking at basically 200 basis points higher yield on a 2-year Treasury bond versus a 10-year Treasury bond. Of course, during this environment, the yield curve is shifting up also. So interest rates are rising, and short-term interest rates are rising faster than long-term interest rates. So we get to this situation where we will not have the normal upward sloping to the right yield curve. We will get an inversion. And that's something you want to watch for this time. Next point, when the Fed starts hiking, what happens? When the Fed starts hiking, usually I would say bad things happen. Those bad things tend to be deflationary. And what we're providing here is data going back over 100 years. What you're looking at is the US Fed fund rate, the target rate. And you'll see in perspective how low it is now versus the environment that Marshall was talking about, 1981. That's when, of course, Paul Volcker was stamping inflation on the system. And you saw that Fed funds actually hit 20%. Today, it's quite a bit lower, almost zero. But the red circles point out when Fed hiking happens, what's happening, of course, is those institutions or industries or countries that are heavily financially levered to bonds or to interest rates with borrowings, something happens. And typically, it will be in an industry or two. Unfortunately, it often appears to manifest itself in the stock market. And we do see the 2 or 3 times that we have had Fed tightening bring on a stock market catastrophe or problem. I think that's one thing that the Fed has been very concerned about in the last couple of years. I'd be hard pressed to believe that the Fed didn't think there was some inflation in the last couple of years, but certainly a fear that they wouldn't want to, they tighten too quickly, raise rates too quickly. That would affect margin balances. Firstly, that would affect the leverage within the financial system, and it would bring on a collapsing economy and therefore collapsing stock market. Now, I mentioned there were 3 or 4 graphs I think are critical. This is number 2 is really critical. The number 2 one is this one. It's really critical. And understanding or appreciating that somewhere between probably 20 to 40% of your typical client's assets are invested in bond funds or individual bonds, I wanted to provide some information about how sensitive bonds are to changes in interest rates. So what I did here, and bear with me for a moment to explain the data here, in the top left-hand corner, I created 6 notional bonds. And you could call these Government of Canada bonds, you call them US Treasury bonds. What I did is I created those 6 bonds. And of course, they're priced at par. That's the second line in the table. And I issued them or priced them all at 2%. So I assumed a flat yield curve for the Government of Canada, 2-year to 30-year, priced all the bonds at par. Then what I did is I subjected each of those to a 100, a 200, a 300, and a 400 basis point increase in yields. And that's the right-hand column. It says yield per year. What I did was I took that entire yield curve, those 6 bonds, and repriced them at 3%, 4%, 5%, and 6% interest rates. Now, we could argue that I should do this analysis higher, and actually, I'm tempted to do this much higher because I don't think 6% Government of Canada rates will necessarily stamp out the inflation we have right now. But the importance of this graph is that we appreciate that on a mark-to-market basis, clients are exposed to market value degradation and decline with rising rates. I think most individuals understand that on the investment advisory side. I don't think that's the issue. I think one of the issues, though, is that portfolios today have very low coupons, 2, 3, 4, 5, 6%, unless you have clients that bought bonds gosh, you'd have to go back almost pre-2008 to get a double-digit coupon in your portfolio. What's happened there is because you have very low coupons, the duration and the convexity is very high. Not only because of the maturity, the coupon is very low. And on top of that, because of the low coupon, and there are no contingent claims, there are no call options or put options in these bonds, they are extremely, extremely sensitive to interest rates. So for example, let's say your client's portfolio, let's go to column number 3, it says 10-year. Let's say your client's portfolio today is worth par, it's worth $1,000. If rates were to rise 100 basis points, or let's say 200 basis points, the value of that holding would fall to $836. The line we're looking at on the graph is the gray line. It's the middle of the family of 5 curves. That's the market value of the 10-year bond as interest rates decline by 1%, and then as interest rates rise by 1, 2, 3, 4, and 5. So what you're seeing here is that on a mark-to-market basis, all things being equal, your client's portfolio would decline by 16.4%. And that's on a 10-year average term portfolio. On a 20-year term average, you'd be looking at a 27% decline in the market value of the portfolio. And as we're all aware, clients do monitor the value of their bond holdings. So I want you to be aware and cognizant of the sensitivity of those bonds to changes in interest rates. And that is the purpose of this particular slide. I think some folks are quite surprised that even a 20-year bond, even a 10-year bond would decline that much in value. One of the issues, of course, is that this is all being done at a 2% par bond. And that's not a lot different. If I ran this entire analysis at 3% or 4% coupons, the results would not be materially different. They'd be 1 or 2% difference in market value decline. Of course, if your client does not have to liquidate early, then this is not an issue. They will reinvest the coupons they have in the current portfolio. They'll actually reinvest them at higher interest rates if we believe these scenarios, if these scenarios come to be fruition. And they're actually going to get a higher, what they call a realized compound yield over the future life of their holdings. On the other hand, if your client is going to have to liquidate, say within the next year or 2 years, part of their fixed income portfolio, this is the kind of issue you're going to face. You're going to face a rather dramatic market value decline, of course, depending on how what the average maturity of their portfolio is or the bonds they hold. Okay, what do we do? Well, if you're concerned that interest rates are going to rise, probably because of rising inflation, the best thing to do would be reduce the bond portfolio's average term to maturity or its duration. And of course, as you reduce it, as you saw in the prior table, as you pull in that average to a lower number, shorter term to maturity, the sensitivity to the price of the bond portfolio to rising interest rates will decline. And of course, in the extreme, if you sold their bonds and went to money market, of course, their wealth would suffer no degradation, no decline, because of course, treasury bills will always return par. The pros is this is usually easy and quick to implement. It's whether it's done with managed products like mutual funds or ETFs or done with individual bonds. It's fully customizable. You decide with your client what kind of average term you're comfortable with in a fixed income portfolio versus where it is today. Tends to be low cost, even if you are dealing with individual bonds. Bid-ask spreads tend to be small. If you're going to make these duration changes, probably you're going to make them through government of Canada bonds rather than corporate bonds. And the only con to this is that you will undoubtedly, well, depending what type of account it's in, but if it's in a non-tax protected portfolio, you're undoubtedly going to throw up some capital gains in the process and accelerate some tax payments. Now, looking beyond duration adjustment, what else could you do? There are some inflation-linked bonds. Most of these were issued in the 1980s, actually in the 1970s in the United States. The two I'll talk about here quickly are the U.S. Treasury TIPS. Of course, they're guaranteed, fully guaranteed by the U.S. Treasury. They're issued with 5, 10, and 30-year maturities, and they pay a semi-annual interest payment or coupon based on a real coupon rate. Those the majority of that market that's outstanding is at 2.5% to 300% coupon. But what happens is that number is fixed. But what does happen is the principal amount of the bonds is adjusted upward or downward by the CPI. So in essence, if you say you invested $1,000 par, and let's say inflation was, to pick a number, 10%, a year later, the coupon payment, say you bought a 3% one, the real coupon, you would be paying 3% not of the $1,000 you lent Uncle Sam, you would be actually receiving 3% on 1,100. So the CPI adjustment is in the principal amount of the bond. Coupon itself actually is constant. The real coupon is constant. They are less volatile than fixed term US bonds. So you have a benefit there that you won't have as much volatility in their bond portfolio. They do tend to have very good correlation numbers, meaning very, very low correlation numbers with other asset classes. They tend to be much less volatile than fixed rate, fixed term bonds, especially of the US government. You do have a deflation floor that is in the likely environment where you would have negative CPI, you will always get par back. So there is a floor on these. By the way, in Canada, there is no floor. And I'll talk about it in 1 second. They're very liquid. And again, the only issue you deal with is you could pick up some cash tax acceleration if you trade them. Real return bonds is the cousin, if you want to call it, to the TIPS, issued again by the federal government, issued also in 5, 10, 30-year maturities. Same concept. There is a real coupon rate adjusted semi-annually, and all the comments are the same. These in Canada are based on the adjustment is based on CPI. Again, they're less volatile, and they do have this unique quirk to them that if you actually had deflation from the point they were issued, the interest and the principal repayment is, the principal repayment at maturity is actually less than the amount you lent to the government because there is no floor. Moving away, those are both U.S. government and federal government tools, Canadian federal government tools to invest in a product that does offer some sort of inflation hedge. The other market, which is bigger, much bigger, is floaters, which are floating rate notes. All kinds of issuers, corporations, banks, life insurance companies, as well as the government, of course, which we just talked about. They offer something a little bit different. The other ones had a fixed real return, a fixed real spread, I should say, applied to a inflating principal amount. These are variable coupon. They come in many flavors and colors. They can float off Fed funds, 3-month, 6-month, 1-year bills, or a multitude of interest rates. The beauty of these is you can pick where on the curve you want to be, at least from a coupon setting point of view. The market is primarily a 5-year and under market. The beyond 5 years would be government issues and some banks and life insurance companies. Industrial corporations are non-financial companies that do issue FRNs. They typically tend to be, I'd say, almost all under 10 years in my experience, with a lot of them being under 5 years. The spread you have to be cognizant of. It's going to be driven by two things. First of all, what is the credit rating of the issuer? Number one. And number two, again, is what is the term to maturity of the FRN? Now, with regards to another type of hedging vehicle, of course, there are many ways that the client can deal with the issue of rising interest rates and declining bond prices. Number one, as we just discussed, they could sell their bonds or sell some of them and buy shorter term bonds. If they had a margin account, they could use bond or bill futures and short those in order to hedge, say, their current portfolio, or if it was a speculation, an outright bet on rising interest rates. On the other hand, we do have inverse bond ETFs. They're quite popular. They're referred to as bear bonds, of course, and they're designed to move in the opposite direction as bond market prices. So what we're doing here is we're saying, okay, I can't short individual bonds, fine. Perhaps that's a good idea for most clients. On the other hand, I want to have an investment. In this case, I'm long the ETF, but the performance of the underlying ETF will be such that as interest rates rise, the value of the inverse bond ETF will go up, and therefore providing me some inflation protection and or a hedge over my bond portfolio that is going down in value in rising interest rates. The only comment here is that KYP and KYC due diligence standards are important to observe. I don't know if any of these are levered anymore. Of course, they're inverse, but the only recommendation I have here is that if you were using these, again, as with most ETFs, better to use them on a tactical basis rather than a strategic long-term commitment to them, because they won't perform over long periods of time. I'm looking at years. If you're trying to protect a client's wealth in the short term, a wealth in their bond portfolio, I should say, then looking at inverse ETFs might be a vehicle, especially if they have large tax bases on their bond portfolio. Okay, moving to commodities. What we're dealing with here is, by the way, this is one slide that does not go back for 100 years. It go back to 1992. And there's really two messages in this slide. The title is Commodity Correlation with Inflation. What we're seeing is over that period of time, according to Bloomberg, we're running about a 2.5% inflation. That's US CPI, by the way, whether we believe it or not, but that is the US CPI. And what we're looking at here is what sort of gains, what sort of rate of return did the market, did those assets provide since 1992 through 2016 for every 1% change, annual change or rise in CPI. So, for example, if you look at the S&P 500, it bears evidence that, guess what? If CPI is low, bond returns are positive, no one's arguing with that. And you're getting, in this case, you're getting, looks like about almost 3 times the rate of return on a well-diversified index versus the CPI. And as you go down the list, you can see that other assets in particular, well, these are all commodity assets, that they demonstrate levered returns to the CPI. So the good news is you can see that there are assets, commodities, that are very sensitive to the price of inflation. And that's not a surprise, and you don't take the seminar to know that. I think what it provides is, at least for that period of time, a good handle on just how sensitive particular assets are versus other particular commodities are versus other commodities. Now, the only constraint here, of course, is that if we're looking at using commodities as a hedge, the one thing we are picking up, the good news is we should be getting levered returns to CPI. The bad news is we're picking up a lot of leverage, and that will make the returns for your clients' portfolios, as in their commodity portfolio, much more volatile. So, with the good always comes the bad, as they say, there's no free lunch in the capital markets, there's no free lunch in the commodity markets. And I think this gives you an idea, or at least based on that period of time, almost 30 years, what type of performance can come out of commodities versus CPI or inflation as measured by CPI. Of course, the issue here is that, again, what role do commodities play? Is it tactical or is it strategic? If this is going to be taken on as a tactical exercise or strategy, then the issue becomes, well, will you be able to move the client to, say, an underexposure position to commodities when inflation is calmed down? That would be the one issue in dealing with the commodities, is if you take them on as a timing vehicle, it's going to be volatile. On the other hand, if you commit to commodities, a portion of the portfolio, as a strategic situation, and that's taken into a portfolio context, you can see the power of commodities in protecting client wealth and trying to provide inflation-adjusted returns in periods of inflation. So a lot of words there, but again, good news is commodities certainly respond to inflation. You knew that before you took this course. On the flip side, just want you to be aware how volatile some of these commodities can be. One thing that I think the slide helps put in perspective is that what we're looking at here is going back 110 years. We're looking at the CRB index, its annual total return, and that's what the dark blue lines provide. I think the thing that's important to take from this, and I don't want to put words around it, but if we do look at the rate of return of the CRB index annualized from by all this data is for the year, for the annualized calendar year. In this case, the annualized return so far this year is 144% on the index. And what I find interesting about that is I'm the same roughly vintage as Marshall, and I actually worked for Exxon in 1976, 77, 78 before I transferred to Imperial Oil and worked in Canada for them for a decade. I actually was working with Exxon when the Yom Kippur War happened. And I remember at the refinery I was working at overseas, I saw crude oil go from $3 to $12 in almost 6 months, just under 6 months. And in my mind, I regard that as something, wow, that was just, it was a career starter. I don't know if we'll ever see it again. No, probably not. And guess what? We actually are in a situation now where measured on the CRB, we're actually have, this is larger, number one, annualized return, albeit it's annualized. But the second point is that in the Yom Kippur War and the oil shocks, that was increasing price of oil, which then went ahead and affected the prices of commodities in the real economy, which then affected the CPI, PPI. Here, it's a little different animal because what I'm seeing is although oil prices have been volatile, up to $130, $140, we've all seen that, what we're seeing is broad-based inflation. And it's covering everything from grains to fertilizers. Actually, some of the base metals have been behaved well. With the issues in particular in Ukraine and Russia, we're now seeing coal take off. So we do have a situation which, if you look at 110 years worth of history, the commodity index is screaming like it never has before. The other thing about, we're going to move into equities in a moment, but one thing I want to do is to provide some perspective. This goes back to 1970. And the question becomes is, how has the commodity index or the price of a broad-based index of commodities, how is it performed on a total return basis versus the total rate of return of the stock market? In this case, the S&P 500. So what you're seeing is the performance, the rate of return on the commodity index, Goldman Sachs Commodity Index, versus the rate of return the S&P 500. And again, I don't put many words around this, but I put the comment here, commodities have essentially been ignored post the 2008 great financial crisis. Inflation hedging or not, I would suggest, not providing advice, but I look at this slide and say, well, this is interesting because as far as I know, I'm not trying to be sarcastic, but as far as I know, we're still building houses out of aggregate and out of metal, and we still need copper. We're building electric cars. We need all kinds of commodities. And actually, I find that we do have a situation here where the market, the stock market, has completely ignored commodities. And albeit, I would say Zoom and Facebook and Microsoft and on and on and on, I was definitely caught the investors' attention, especially since 2008. I'm not saying it's a bad thing. I'm not saying it's a good thing. What I'm saying is commodities and commodity producers have been, or commodities have been ignored, totally ignored, and are quite cheap relative to what the stock market has returned. Commodities, different ways to go. You can do direct physical investment. We could talk for quite a period of time with all the issues there, all the pros, the cons. The direct is great because it is direct. You saw on that slide number 2, I think at the beginning, the price for commodities, for example, gold, it even outperforms the performance of gold stocks. You don't have issues with companies having issues in producing their product. But however, as you know, there's a lot of issues. You have appraisal issues, you have storage issues, you have insurance issues, transportation issues. That's something most of your clients probably are involved in. Again, if your clients are or not, you're not licensed for futures, that would be the other approach to take if you don't go physical. Of course, that's the one that tends to be the one pursued primarily by institutions, institutional investors, hedge funds, life insurance companies, and so forth. And then last but not least, we go to equity investments, which we'll talk about in detail in the next few slides. And we're looking there at either going in through an ETF, or it could be a mutual fund, which is directly linked to underlying commodities. A single ETF, single stock ETF, most of them are basket ETFs or index ETFs. We can then look at a sector fund, which deals with just one commodity sector, let's say base metals or precious metals, or one that actually looks at a number of different types of commodities. Could also be CRB based, quite frankly, or Goldman Sachs commodity based. And last but not least are we looking at individual commodity rated equities. Now, that's the third slide, which is to me very important, and that is equity performance inflationary period. So the first thing we had to discuss is, how do equities perform inflation? The answer is it's kind of a mama bear, baby bear, papa bear situation. If it's a mama bear, other bear, probably mama bear, baby bear, guess what? Inflation tends to be low inflation. Moderate inflation tends to be supportive of equity prices. As you know, a lot of companies investor focus on top line performance, revenue and sales. 3 or 4% inflation makes the numbers look good. If they can add a few percent of unit growth on top of that, then they start pushing 6, 7, 8, 9, 10% total revenue growth. Stock market's usually pretty happy with that. That's fine and dandy. The issue here, though, is when you get higher inflation, two things come up, and these are key. The first thing is, can the industry sector, how successful is it passing through rising costs to customers? And again, good analysts, good advisors, you're going to look both at where is the revenue growth coming from? Is it coming from selling more units or more volume? Or is it selling these units at a higher price per unit? And I think what you discover is that at some points in time, pass-through is relatively successful in a number of industries. What you'll find as inflation goes higher and higher, you're going to start getting consumer pushback. They're either going to cancel a service, not buy a service. They may end up actually going to, instead of premium products, go to discount products. That's one thing you see in the grocery store business where, yes, sales are up. Well, they're up because everything costs more, so their sales have to be up. On the other hand, their margin generation might not be that good because if they're selling non-name brand products, which perhaps have higher margins, sure, they're selling more products, but they're selling more no-name type products that have smaller margins. So the top line growth may look okay. The issue is the margin growth is suffering. And you will see that rolling over industry to industry to industry. So you want to make sure that you're very cognizant of the ability of the sector and the companies you're investing in to be successful at passing through rising costs. What we're talking about here is margin compression. The second one is another compression, that's multiple compression. And you might ask the question, well, Bruce, in slide number 2, you showed me the rate of return on the price of gold, and it's really high graph, and it's 20, 30% a year, and that's super. But yet the equities didn't perform as well. The reason is, of course, when we discuss the bonds, higher inflation generally leads to higher interest rates, which leads to higher discount factors, discount rates. Those discount rates affect all future cash flows, whether it's a bond in terms of principal interest, or it's a stock in terms of dividend or some type of profit share, and the eventual price of the share in the future when you go to sell it. Discounting mechanisms are part of our markets. So what will happen, of course, is all of these securities, even equities, they start looking like bonds. If the discount rate goes up, the value of a bond has to go down. If the discount rate on dividends and future profits in a company goes up, the multiples will have to go down. So this is where you can get this perverse situation where it looks like companies are generating more revenue, and they are nominally. Their margins may be starting to suffer. That's not good. Eventually, that'll be reflected in the share price. But on top of that, we're going to have margin compression. And margin compression is brutal. Margin compression will be applied to all equities, to all types of investments that have future anticipated cash flows. And of course, equities do. We expect to get a dividend and or sell the stock for some value in the future. So that's going to be discounted. Okay. So this slide is key and it has to be kept in mind. And both of, especially in a sector, so multiple compression will affect the entire market. It will affect individual industries differently. And part of the reason it is the first point, and that is the margin compression is happening, the profit margin compression is happening in the industry. So what's happening here, of course, straightforward, sector selection is critical to provide greater inflation protection. And we already discussed what sectors appear to be favorable in that area. And sector performance is heavily influenced by ability to pass through higher cost. And 2 slides of that, because I think those 2 points are really important. If you look within the market without picking particular names, I thought I'd have a 2-dimensional plot here. On the x-axis or the abscissa, we're looking at what's the higher probability of beating inflation. And on the vertical axis is what high level of outperformance can you actually get. So if you think inflation is going to be higher, where in the market do you generally want to be overweighted or underweighted? Of course, if you believe inflation is going to accelerate, go to higher levels, you're going to want to be on the right, you're going to be in the top right-hand side quadrant, closer to that. And vice versa, the consumer discretionary, the IT, anything fixed income related, mortgage REITs, telecoms, utilities are going to be your poorer performers relative to the stock market. Superior performance is going to be on the healthcare, precious metals, commodity related sector. So commodities tend to be top performers. Commodity stocks tend to be top performers for 2 reasons. Well, number 1, guess what? Our assets are commodities. And the issue here is that commodity prices are going up. If we're in an environment where labor is going up, or there are some demand issues bringing inflation into the market, commodities are still a good place to be. On the flip side, we may be in an environment right now because of COVID lockdowns, because of transportation issues, logistical issues, because the unfortunate things are happening right now in the Ukraine. We have a situation where we're having supply issues at the same time. It's not only what should the price of wheat be tomorrow? The issue is, will I be able to get the wheat I want? Will I be able to get the fertilizer in the fall that I need or later this year or not? And of course, in those kind of environments, that is not like prior environments. Prior environments, but the price was high, consumers push back, maybe change their habits. On the flip side, we now have a situation where some of these products are just not available, period. And we're having that with computer chips in terms of manufacturing new cars and trucks and what have you. So number 1, the commodity related companies, guess what? They benefit directly. It's a direct drive. They have higher commodity prices. So they're going to get margin expansion, all things being equal, assuming their input costs are not going up, which by the way, they are. I listened to the Newmont conference call last week. I'm not a Newmont shareholder. I don't recommend buying it, but I do listen to these calls. And the word inflation probably came up 30 times in an hour-and-a-half presentation with questions with analysts. They're looking at their all-in sustaining cost rising over $100 an ounce in the next year. So if you're Newmont producing 6.9 million ounces a year and you're seeing issues in April of this year with getting services, with getting cyanide to produce, to separate your gold, if you're having all kinds of cost pressures, well then, guess what? You're seeing margin compression in that area. Of course, the issue then becomes is, will the price of gold go up? That's another discussion. And then last but not least, The other thing in valuing commodity companies, you're looking at two things. A short-term thing is what's your margin? And that appears usually in a price to cash flow or EV to EBITDA type measure. Analysts will use these ascribe 40 to 6% of the target price value to something related to short-term performance of the company. The remaining part will come from basically the net asset value calculation and what multiple net asset value the company, what proportion of the value future price will come from the net asset value, what multiple of the net asset value the analyst puts on it. And of course, if the commodity price is going up, with the reserves that are sitting in the ground, wherever they are, they're going up in value. So they do have a higher net asset value. So there's a double-edged prong there. So what's happened here? Here we're looking at the S&P index, and a lot of squiggly lines here. But one thing I just want to point out is that if on the left-hand side you can see that commodities, as I indicate in the bottom right-hand side, they were 27% of the weighting of the S&P 500. And now in 2022, you can see how the role of commodities in terms of the market cap is so diminished. So if you're looking, for example, I know we're doing a Canadian audience here, but I think a lot of folks are quite surprised that even in America, the constituency or the component of the public capital market that's commodity related is de minimis, totally de minimis. Of course, that makes the Aussie and Australian and Canadian stock markets in general more attractive from a materials and energy point of view. What I compared here very quickly, just took year-end numbers, last year year-end. We're looking at the column showing the weighting in the TSX composite of those particular sectors, market sectors, or industry sectors. I'm then showing the S&P index in the middle. And on the right-hand side, you're seeing the TSX minus the S&P 500 index weightings. So what you're looking at here is quite a spread. You're looking at nearly 20% of the Canadian market, more than 20% of the Canadian, more than 20% of the Canadian market representing energy materials vis-a-vis energy materials in the S&P 500. One more thing here, looking at that 20-year period of time, what we're looking at is a rolling 10-year excess return annualized. This is the rolling 10-year excess return annualized between the S&P 500 versus the TSX composite. So we're looking at longer term smoothed out the rate of return, the market rate of return for the two indices, S&P minus the TSX. And of course, what we're seeing here is when you get into the boom we had starting in the turn of the decade, this was primarily on China building, China construction, the expansion of the Chinese economy, and of course, taking in commodities left, right, and center from Australia and Canada. Of course, you had superior performance on the TSX because of course, our energy and our particular our materials weighting and gold and silver. So what you had was actually the negative here is actually outperformance of the TSX versus the S&P 500 by 500-600% a year. That's 10-year rolling numbers. That's not year-by-year numbers. On the flip side, we now had a situation where the U.S. technology boom in particular has resulted in S&P 500 returns outperforming the Canadian market by, well, right now we're looking on a rolling basis, almost 700 basis points a year over a decade. So again, the market returns is consistent with the data I provided with you on the earlier slides. The good news on the specialty sector funds, we can get some inflation efficiency in the portfolio. I think that's pretty straightforward. You get the diversification on top of that. And the second thing, individual stocks, they can offer superior returns, absolutely, but they require, of course, additional analytical skills to be put into them. Okay. Of course, for most clients, sticking with ETFs or mutual funds or well-diversified commodity portfolios would be the way to go if you decide to use commodities as a tool. Very quickly here in the next two slides, when preparing this, I thought, let's have a look at what would, from an inflation point of view, I'm very careful from the inflation protection point of view, what would an ideal industry, what would an ideal company look like? In this case, the restriction is it has to provide protection, potential protection against inflation. And number two, I want it to be a public equity. We can do things with commodities. We can do things with managed futures. Yes, we can. And clearly, the streaming and royalty companies would be the superior investment in that regard. It's a very small sector, which is good news and bad news, but it's a very small sector, only listed in Canada and Australia primarily. In the US, we have some. They're primarily focused on, I think I looked at the total, they're 95% based in precious metals, with 5% being oil and gas. And what, of course, they're doing, the streaming royalty companies are providing CapEx or development funding as alternatives to mining companies, as an alternative to either borrowing in the bond market, assuming they can borrow in the bond market, or borrowing from a bank. And of course, banks have shied away from commodity investing for the most part. And last but not least, secondary stock offerings. They step up to the plate to provide that funding. That funding is not considered as debt or equity on the balance sheet of the company they've invested in, or lent to, I should say. What they own is a right to receive a percentage of revenues or production generated via the extraction of the commodity or the resources. They have little to no debt. Most are always profitable, very, very low break-evens, extremely low. They constantly generate free cash flow. That's a given. They actually have built-in counter-cyclicity. If you look at the history of these companies, you'll find that when commodity prices are low, of course, that is the most inopportune time for mining companies to either do secondary stock offerings and or borrow in the bond market or from the bank. And that's when these companies with their free cash flow, they step up and they get their good pricing at that point in time. So they actually are, all of them, I've quite familiar with the sector, they've done a really good job of stepping up to the plate when times are tough in the commodity business. They have very small fixed costs. A lot of these companies have less than 40 employees. They have the largest market cap per employee of any S&P 500 company, including Facebook, Zoom, everything, Microsoft, whatever. Attractiveness, again, they're ideally built for inflation. That is, they have no exposure to inflating mine costs because they get the production, and they get the production at a fixed price for the life. And if they're perpetual, then they have a call at a fixed price of all future production growth from the reference assets. So even if they do a streaming deal, let's say 100,000 ounce mine, if that mine in the next 3, 4, 5, 10 years produces 115,000, 120, 150,000 ounces, the company gets its proportionate share of the larger production, and they don't pay for that. They have paid for that when they made the initial investment. And of course, the commodity price growth is there. They get all the upside because they're going to unload the gold or the silver or whatever, the copper, in a market, where commodity market, where it's going up. So they really have free perpetual call options on commodity price growth and future production. And guess what? They generally only have 15 to 40 employees or less. So they're not very exposed to inflation at all. And that's why they're always profitable and they generate free cash flow. One very quick example here of something that occurred last year. And I'm surprised we didn't see more of this. But Newmont last summer announced that it was going to modify its dividend policy. Its dividend is broken into two parts. It's now implemented. It was implemented fourth quarter last year. And what I did a projection here of what as to what the dividend yield would look like on Newmont. Again, not recommending you buy Newmont. I just wish that more commodity companies had adopted this type of a strategy. It has a lot of virtue to it. And what happens is they articulated that they wanted to have two pieces to its dividend payout policy. And what we're dealing with is, number one, it is constructed that it pays out 40 to 60% of its incremental free cash flow. And it would be supplemental to the base dividend. Now, the base dividend is $1 a share, and that the company feels is sustainable at $1,200 gold. So that you have in place. On top of that, they adjust the annual, they provide an annual supplemental dividend, formula driven, and it's formula driven to be 40 to 60% of whatever the incremental free cash flow is with the company. And the annual dividend right now is the supplemental dividend is 60 cents on top of the $1, so it's $1.60. And that's actually based on the low end. They're currently based on 40% of the free cash flow, and they're assuming gold at 1,500. So the comment at the bottom is mine. I just made a comment that you can see what happens looking at, in my scenario, what I did is I took different gold prices and different payouts. So for example, let's assume they the board decides to pay out 50% of its incremental free cash flow. And let's say gold is trading at $2,000. Then you're going to be following the, I guess it's an orange line in the middle, the 50% line. If you go to the $2,000 mark for gold price to pick a point, what you're going to look at is basically a 5% dividend yield. So what you're seeing here is how the yield on Newmont Dividend will vary with gold price and with the degree or the amount of incremental free cash flow the board will declare. And that piece is defined by barriers at 40 and 60%. So again, not many companies follow suit with this. And I wish more had. It would give you and your clients more opportunities to look at investments where, in this case, hopefully the fortunes of the company are improving if gold prices are increasing, if inflation's increasing, and they keep their margins under control. But in addition, you're getting that extra kick, I'll say, on a dividend basis through the higher commodity price.
Great. Bruce, it's Marshall.
Yeah.
We're at 1, just slightly past 1. I think maybe we'll go to 1:10 if that's okay with
that should be good, Ron.
Just so you can finish up your presentation, and we'll take a couple of questions, and I think that should do it. So sorry to interrupt, but just wanted to let people know we'll go an extra 10 minutes.
Okay, thanks for that. So there's a little repeat here, and on this particular slide, the first point is equities as represented by broad-based indices are not good inflation hedges. So a lot of the popular press suggests, oh, well, keep the bond portfolio small, keep the equity portfolio large, blah, blah, blah. History does not prove that's the right thing to do. Reducing fixed income and reducing its duration to within your guidelines is probably a prudent thing to do. On the flip side, on the equity side, you have to be more selective. And not all equities are created equally. You know that very well. And in inflationary times, a lot of industries have a very hard time passing through higher costs, number one. And number two, the discount factors or the multiples, the discount are going up. So multiples will go down in general. And those industries that cannot maintain margins, it will be more brutal, meaning more negative, okay? The last part is that keep in mind that if you are moving into volatility type investments, whether it's direct or through futures, derivatives, or through individual stocks or even indexes, stock indexes, whether ETFs or mutual fund vehicles, you are going to have more volatility in the client's NAV. However, that's part of the price you would assume in order to try and get some more inflation protection. Alternatives, we'll go through this pretty quickly. Of course, there's many ways to real estate was included in my slides. It does provide inflation protection, not as much as commodities, but it does provide inflation protection. Of course, the two things you have going for you there is number one, the asset you own is hopefully inflating and rising in price with inflationary environment. Number two, by resetting your rents, you should be getting or hopefully maintaining your cash flow margins or your return margins over time. Those are good things. Of course, different ways to get into that is either through direct investment or some type of pooled vehicle, or you can try and acquire that, of course, through individual equities or ETF and mutual fund real estate related equities. Hedge funds, Marshall mentioned, I do have a history with hedge funds. Of course, they are typically structured to provide absolute returns. Generally, they're structured to provide low correlation with traditional asset classes. How successful they're that's a matter of another session. But having said that, those goals could be maintained or realized. But by the way, that may not provide superior inflation adjusted returns. So that's one thing I want you to be very cognizant of when looking at your hedge funds. If you have clients invested in hedge funds currently, or you're looking at some, I really suggest you, look, in addition in your due diligence, have a look at how the funds have performed in inflationary periods. Here's the problem. Most hedge funds didn't exist when you go back to prior inflationary periods. I mean, hedge funds is really, seriously, a 2-decade-old industry, probably at most. I mean, George Soros and whatever was around when the Yom Kippur War happened. I understand that, but generally speaking, the database is very small there. So you're going to have to appreciate in the hedge fund manager strategy where they can articulate to you very clearly how their strategy will benefit from inflation. So you want to ask that question of all the managers, all the managed product you invest in. You want to ask your manager, how does your fund behave in inflation? Absolutely. And what are the drivers of the return? And how many are inflation related or inversely inflation related? Okay. CTAs and futures shine in a high inflationary environment as a sector. Individual managers, of course, can have issues. But there again, too, if you're looking at alternatives, same comment on managed future CTAs, same due diligence. How have your funds performed over time, albeit they're in the futures market? Are the futures commodity related or are they financially related? If they're trading financial futures, I don't know why they would benefit in the inflationary period. They actually may suffer. If they're in the real economy, investing in all types of commodities, albeit well diversified, you might have a superior product there. So the hedge funds and CTAs and managed futures, same level due diligence. I'd suggest at a distance, the managed futures and CTAs as a group will probably outperform the hedge funds if we are at or go into higher inflation environment. The cryptos and the collectibles, can't say much there. On the cryptocurrencies, of course, one of the issues there is that it really crypto tends hard to measure. Let's say it's a 10-year-old at most sector. So we really haven't had the benefit to see how they perform. Certainly, if you look at performance over the last 3 months to 6 months, it's been pretty abysmal. But I can't articulate to you, and I haven't researched. My research suggests that that's related to increasing inflation or what have you. So at this point, I wouldn't include crypto in the mix. And more importantly, I have no reason to include it because there's no data to support how it will behave. Is it an inflation hedge or not? Collectibles, we all hear anecdotal stories of, your uncle or grandfather who bought a 1972 Ferrari and drove it for a day and threw it in the barn and then you discovered it, 30 years later and it's worth $1.7 million. That's all fine and dandy. Of course, collectibles are not liquid. You have issues with valuation, forgery, insurance. It goes on and on and on. Not to say that there aren't particular collectibles that have done well over time. And that's the end. And I just want to finish with this one cartoon. I don't normally post cartoons, but I came across this one. It's 41 years old. And that's kind of interesting because Marshall's introduced this with a bit of context of history. I didn't realize he was going to do that, but I want to end this with a bit of history. And all I can say is now 41 years later, maybe things haven't changed a lot. But anyway, with that, I thank you very much for your attendance. And Marshall, can you open up to questions?
Sure. Well, thank you so much, Bruce. That was great information and perspective. And we've got lots of questions, but not a lot of time. But I think maybe one common, and you answered a lot of the questions in your subsequent slides after the question was posted, so that's great. But one sort of a common theme is maybe around this. If you think rather than being in the early stages of an inflationary cycle, where maybe at the later stages, maybe this sort of cost push inflation is going to exhaust itself, and maybe we're towards the end of the cycle rather than the beginning. What are the leading indicators you might look at to give you an indication of a change in outlook, and what sort of investments might perform best in the early stages of a maybe declining inflationary environment? So that's sort of a general theme of a couple of the questions.
Okay, it's a good question. Let me start with the Fed first. we are very much in a Fed-driven market, and I think we have been very much since the first QE with Ben Bernanke now over a decade ago, where the stock market in particular, and of course the bond market, obviously, is very attuned to where the Fed is, where their head is at. My personal opinion is that the Fed is behind the curve. They could have been moving in tightening. I'd say even a year ago, I would say, you talk about signals, Marshall, I think the proof in the pudding is you and I thought up the course now 18 months ago. So we felt at the time even that there was a need for a course like this because inflation looked like it was starting to, its head was starting to peak out a little bit. And the other thing is the Fed hasn't done anything. So I'm very surprised at that point in time when we were talking about a year and a half ago about creating such a course, that the Fed really hasn't done anything about it. So they're doing a lot of job holding, they do a lot of talking, a lot of warning, a lot of hinting. But I think the bond market is doing their dirty work for them. We saw the yield curve starting to invert earlier in the year. Quickly. I think the money market was saying the Fed is going to get involved. They are concerned. They're going to try to slow things down. I think the issue is that when you see how the bond market has responded, is the way it's sold off. The bond market is doing the dirty work for the Fed. The rates are starting to rise. I think we're early in the game, quite early in the game. I think why I say that is because when I look back on prior inflationary cycles, and of course I spent my entire career in the bond market, primarily the US bond market, when I would see the Fed lean against the economy and try and slow down inflation, we're not talking about 25 and 50 basis points. We're talking about 3, 4, 5, 6, 7% in order to slow down the economy. That was demand driven. So they had to decrease the demand for housing, real estate, and general inflation. I think the one thing today, which is problematic, is there's a new kid in town. I think the kid in town is that we have a supply issue now also. So we have a strong economy, relatively strong economy, at least in the States and Canada, maybe not so much in Europe and Japan, but we do have a relatively strong economy. However, I think that these issues that have come out of COVID, and particularly the supply issues, the logistical issues, and then on top of that, the unfortunate stuff going on in the Ukraine, I think we haven't seen anything to suggest to me that inflation is turning down. If anything, I don't think we've seen the impact of it yet. And when we have a shortage of supply of goods, prices are going to get bid up. As I say, in prior inflationary cycles, you had to cool the demand down. This time we have demand, but by the way, we may not have supply of certain things. So how high can grain prices get? How high can fertilizer prices get? And how does that get passed through the consumer? So unfortunately, at this point in time, I'm not seeing anything there. Now, if the Fed steps in, and I trust they will, they've tried desperately not to for so long, and they got away with it. I think at the same time, they're very cautious that they don't want to upset the stock market too much and the bond market. The bond market's already getting a little bit upset, I think. It's pretty clear. The stock market is not so much. On the growth, the long duration stocks, we put ARC up there, they're reflecting something. They're reflecting a lot of changes. And part of it's inflation, and part of it's high valuation. So the issue with the things we're dealing about today is that I still think there are opportunities to position the client's portfolio for more inflation. I think when we've been through a couple of Fed increases, when we've seen commodity prices in particular start to simmer down, when we've seen logistical issues starting to get cleared up, when we see Ford Motor being able to actually deliver cars to you because they now have the chips from Korea or wherever, to me, that's the turning point. I think then, that's the time you'd want to lighten up on some of the things we've talked about today. But for me, I feel that is something we won't be looking at till later this year, maybe even early next year. Yeah.
Okay. Thank you so much, Bruce. I know we have some more questions. We will try to respond to those questions after this webinar, but I think we've run out of time now. So great conversation. This concludes our event. Again, thank you so much, Bruce, and for everyone for participating in the webinar. A replay of this will be available on our website in the coming days. And as well as mentioned, CSI just launched a course called Investing in Inflationary Times, which reflects a lot of the material that Bruce has presented today. And you can find information on the course on our website, and you can register through our website. So again, thank you all for attending, and have a great day.
Bye-bye.